If you're not clear on these 3 deal-making strategies, it will be challenging to grow and manage a meaningful portfolio. If you want to enhance your abilities to find deals, fund them, develop them, and manage a meaningful portfolio, then you've come to the right place. I'm Joshua Pardue, and over the last 20 years, I've come from a surfer kid in a welfare household to accumulating over $100 million of assets. On this channel, I help visionary investors achieve the life of their dreams by teaching them the skills and strategies to build their own multi-million-dollar portfolios. After watching this video, you'll know several different strategies, including how to acquire an asset direct and below market, how to create value by seeing something in a project that others don't see. Lastly, we'll also be discussing how once you have equity, you can reinvest that for reoccurring income on the low risk, low return end of the spectrum. These concepts can be broken down into 3 key strategies: opportunistic, value add, and stable income. So let's jump right in. Strategy 1 is opportunistic. On the risk spectrum, high risk, high return. The approach is to be willing to do what others are not willing to do. And in some situations, that means take on risk and buy something directly. Sometimes you won't have all the information. Sometimes you'll have a short amount of time. Sometimes you have to figure things out after the closing. Sometimes there won't be access to ample liquidity to get it. But at the end of the day, the goal is you immediately created equity by buying below market. We all know someone that needed to sell something quickly and they're willing to take less money than it's worth. We'll take that concept and extrapolate it to buying businesses or buying properties, and it's a similar scenario. One example that comes to mind is we were working in South Florida with a food preparation company, and we needed to acquire an industrial asset. And we found a bank that owned an old grocery store, and it would work for us, but the bank was in a bad situation owning a distressed asset, so we were able to acquire it low, then bring in our tenant, and now we still own it today as a stable income property, but we started with it as an opportunistic deal. This type of investment, certainly not for everyone. It's for people that are willing to take risk and want to go make a bunch of equity quickly. You typically have to be an expert in the space in order to pull these off and have great access to capital. Typically it's a distressed situation and they're paying for a solution. And so if you're buying an asset 30% below what it's worth, you have to move fast. They're getting the solution, you're getting the baked in equity. How does it fit in a portfolio? Some investors will do all distressed assets. However, others will have a blended portfolio with stable income, some value add, and some opportunistic where they really drive their returns. The second strategy we call value add. Value adds taking an existing business or property that's doing well and has some cash flow in some instances, and just seeing something that others don't see and making it better with further investment of time and economic resources in the team's work. The first scenario is opportunistic, where you may be buying something that has no income and no future, while here you're a little bit more medium risk, medium return. For value add, if you're to buy a car and then repaint it and put better rims on it, and then all of a sudden someone would pay more for it, you made a simple low risk adjustment. If you're looking to acquire a business and while you have it under contract, you recognize that with some moderate adjustments, you can make the bottom line more profitable. Maybe their pricing's a little off, you can immediately increase pricing. Or maybe you appreciate that there's more efficient ways to deliver the product and you can cut out those logistic expenses, driving more to the bottom line. Well, that's a scenario where you're buying an income asset, but you just immediately made it better with low risk calculated adjustments. In the property realm, you see this often where someone will buy a retail strip and the buildings look a little dated and the tenants are maybe not so great tenants. Someone just takes a little bit of investment to redo the parking lot, the landscaping, the paint, clean up the glass, slowly re-tenant it. Higher value tenants will pay more rent with better credit, making the asset worth more. Who is this for? This is for a moderate risk investor. Your timing is a little bit slower on these kind of deals. Typically, you can put it under contract to do your due diligence and make sure at the time that you close, you have your full strategy and full underwrite in place. You're still gonna need some level of expertise in the individual asset class or the individual business, but less, because it's gonna be easier to raise money for something that has existing income from banks and private investors. This fits in the portfolio right in the middle. Some big swings and opportunistic, some stable income properties on one side. This is when you're gonna buy something that you can get to teens returns or 20-something% returns without taking the risk required to get to higher returns. Strategy 3 is a stable income investment strategy. It's lower on the risk-return spectrum. In that situation, you're typically going to buy a stable asset with an existing income. A good example of something like this is the Walgreens that we've all seen on the corner. Someone was opportunistic and bought that land and built that investment for the marketplace. Someone else, once it's income producing, is going to come in and buy it at a higher price, but they're buying the surety of the 20 years of future cash flow, growing at something like 2% annually. Low risk, low return. A stable income property could just be buying a house that's already ready to go and then renting it out immediately after you buy it, just for that simple cash flow that comes off it. While an opportunistic might be buying a piece of land and building the house, or value add might be buying a house that needs $100,000, $500,000 of renovations, and then renting it. Who is this for? This is often for people that don't want as much risk or involvement, or maybe are later in their investing career and they're trending away from risky investments in order to build a portfolio they can live off the income, travel, not work as hard, and not be as hands-on. On the other end of the spectrum, it could also be for the beginner who just wants to come in, I've got X amount of dollars, I want to put X amount out and make Y amount in per year. It's a very simple calculation on what that looks like. To sum all this up, there are 3 core strategies for sourcing deals: opportunistic, value add, and stable income. The key is aligning these concepts with your overall investment strategy. The decision on where to hunt comes down to your risk tolerance, your financial position, and your overall goals. We're still covering the basic frameworks, but we'll get more granular with examples and strategies in future videos.